If you're a startup founder trying to figure out what type of equity to give your team, you've probably heard people say, just give them options, like it's that simple. But the truth is, there are actually 4 different types of equity you can offer: restricted stock, ISOs, NSOs, and RSUs. Choosing the wrong type of equity can cost your employees thousands in unexpected taxes, create a compliance nightmare for your company, and result in a loss of trust from your team. My name is Omeed Tabiei, and I'm a startup lawyer who's helped dozens of founders structure their equity plans. And I'm also a 2x software founder myself, so I've been on both sides of this, which is why in this video, I'm going to break down the 4 types of startup equity, when to use each one, and the tax implications you need to understand before you start handing out shares. Let's dive in. Restricted stock. So, let's start with restricted stock, because this is typically the first type of equity you'll ever issue. When you incorporate your company and bring on co-founders, this is what you're going to issue to yourself and your co-founders if you have any. And restricted stock is typically what I set up for founders that I help with incorporation. Restricted stock is real shares of your company, which are subject to vesting. Unlike options, the employee actually owns the stock from day one. However, the company can repurchase unvested shares if they leave before fully vesting their shares. So they own their shares, but there's a catch: until they've earned them. Now, it's called restricted stock not only because of the vesting restrictions on the stock, but also because the company often has a first right of refusal, which is a second restriction, and the securities laws can create a blackout period when it's illegal to sell your company stock, even if you wanted to. When you first start your corporation, the shares are going to be worth almost nothing unless you're contributing valuable property like a filed patent or other IP or tangible property or assets. We're talking 0.000001 per share, which is actually a huge advantage because of how taxes work. Because the lower the value when you receive the shares, the less you pay in taxes. But if you wait too long to issue your stock, you'll take a higher tax hit because the company has grown in value. That said, everybody has to pay fair market value for their shares. And as mentioned above, usually you're starting with nothing but your good ideas, so the fair market value is 0. But you must pay something for your shares. Payment can either be in the form of cash, reimbursement of startup expenses, forgiveness of loan, contribution of intellectual property, or personal services to the company. Be careful with stock for services though, because the IRS will tax that just as they tax your W-2 income. But the bad news is you have to pay the tax for your stock in cash even when you haven't received any cash from your stock, because the stock is only valuable on paper. If you pay less than fair market value, for example, if your co-founder has contributed IP, the IRS may consider that a gift. The standard vesting schedule for restricted stock is 4 years with the 1-year cliff. What that means is you're not going to earn any of the stock until you've been at the company for at least 1 year. After that initial 1-year cliff, you'll earn about 25% of the stock all at once. When I say earn, I mean it becomes fully vested and is free and clear of the vesting restriction. But if stock isn't fully vested and you quit or get fired, you essentially lose the stock and it goes back to the company. Once you hit the 1-year cliff, your stock vests month over month for the remainder of the 36 months, so over 48 months total, you earn your full allocation. Investors care so much about vesting because they want to make sure that if they put $1 million into your company, the founders aren't just going to leave. The vesting clause ensures everyone earns their equity by sticking around. And when stock doesn't vest, it scares investors because there's no protection for their investment. After all, they are investing in you and your people, and they need you to stick around to execute on the business plan they just bought into. In terms of tax, by default, you get taxed at vesting based on the fair market value of the shares at that time. So if your shares are worth $1 when they vest and you have 1 million shares, the 22% to 37% tax rate means you're paying taxes on $1 million. And that's a lot of money, especially because that $1 million is only paper value, not actual cash that you can access. But the 83B election shifts the tax from the moment of vest to the moment of grant. This is where you can save yourself a ton of money. Because instead of paying taxes when the shares are worth $1, you pay taxes when they're worth 0.0000001. In theory, you elect to pay the tax at grant, and you're taxed on the difference between your purchase price and the fair market value of the stock. And as I just explained, since everybody pays fair market value for their stock at the outset, the difference between the purchase price and fair market value is zero, so bingo, you pay zero tax. And that's a massive difference from paying the tax when the stock ultimately vests. The only catch is it has to be filed within 30 days of the stock issuance. This is not flexible. 30 days and that's it. If you don't file the 83B within that window, you're going to get taxed quite significantly. And I've seen founders miss this deadline and it costs them tens of thousands of dollars. The good news is that last fall, the IRS finally automated the 83B process, and you can now file the 83B election online. The final thing to talk about for restricted stock is the company deduction. Your company gets a deduction when the employee gets taxed. So there's a benefit on both sides when structured properly. By the way, if you're setting up equity for the first time and you want to make sure you don't miss any of these deadlines or structure things wrong, click the link in the description to book a free consultation. I'll look at your specific situation and make sure you're protected. Okay, let's keep going. ISOs. Once you start hiring full-time employees, ISOs are usually your go-to. ISO stands for Incentive Stock Option. These are specifically for W-2 employees in the United States. They cannot be used for contractors, advisors, suppliers, or international team members. So if someone isn't a full-time US employee, ISOs are off the table. ISOs give employees the right to buy shares at a set price, called the strike price. So let's say the strike price is set at 10 cents when they join. If the company grows and the shares become worth $5, they can still buy at 10 cents. They lock in today's price and benefit from future growth. So they don't own anything up front like with restricted stock. Instead, they have the option, essentially a contractual right, to purchase the shares at the locked-in price later on. ISOs are tax favored because of how the taxes actually play out. There's no tax at grant and no tax at vesting, as well as no ordinary income tax at exercise in most cases. The employee only gets taxed when they actually receive the shares, which means they can defer the tax hit for years. The catch is ISOs can trigger AMT, which is the alternative minimum tax. AMT is a tax system designed to make sure high-income taxpayers pay an appropriate amount of federal tax. If you make more than the AMT exemption amount, you must calculate your tax liability twice, once under the regular tax system and once under AMT rules, and then pay the higher of the two. Calculating AMT can get complicated, so I recommend talking to a tax professional. There are also holding period requirements to get that favorable tax treatment, because if the employee sells too early, it becomes what's called a disqualifying disposition. And when that happens, the employee loses the tax benefits entirely. And even if they meet the holding period requirement, where they sell at least 2 years after grant and 1 year after exercise, you only get the benefit of the lower capital gains tax on the first 100,000, calculated as FMV as of the grant date. From the company's perspective, ISOs are actually less favorable. Your company only gets a tax deduction if the employee sells in a disqualifying disposition. Otherwise, there's no deduction for the company at all. So the tax benefit goes to the employee, not the company. NSOs. NSOs are the flexible option when ISOs won't work. NSO stands for non-qualified stock option. These can be given to advisors, independent contractors, suppliers, vendors, and international team members, and essentially anyone who isn't a full-time US employee. ISOs can't be issued to those people, so NSOs are your only real option. And like ISOs, NSOs give the right to buy shares at a set strike price. The mechanics are similar, but the tax treatment is completely different. NSOs are less tax-friendly for the recipient. They get taxed at exercise as ordinary income on the spread between strike price and fair market value. So if the strike price was 10 cents and the shares are now worth $5, that $4.90 difference is the spread, and they pay ordinary income tax on that, which means they're essentially getting taxed twice. But NSOs are better for the company. Your company gets the tax deduction when the employee exercises, unlike NSOs, where you might get no deduction at all. So while NSOs are worse for the recipient, they're better for you in terms of deductions. RSUs. RSUs are more common at later stages, typically Series B and beyond. RSU stands for Restricted Stock Unit. once your company has meaningful value and more infrastructure in place. They're cleaner for employees, but more complex administratively for early-stage startups. An RSU is a promise to deliver stock or cash equivalent at vesting. The employee doesn't actually own anything until the shares are delivered, which happens automatically at the time that the RSU vests. Unlike restricted stock, where they own the shares from day one. With RSUs, it's just a promise until vesting happens. The reason companies use RSUs later is they're simpler for employees. There's no strike price to worry about, and there's no exercise decision to make. They also don't have to come up with cash to buy shares. The shares just get delivered when they vest. The tax situation is straightforward. RSUs are taxed when the shares are actually delivered to the employee. There's no 83B election available for RSUs, so there's no way to shift the tax timing like with restricted stock. And finally, your company gets the tax deduction when the employee gets taxed at delivery. It's the same timing as restricted stock in that sense. Now, choosing which is best for you. So now that we've covered the 4 different types of equity, let's quickly figure out which is best for your situation. For co-founders and your earliest hires, restricted stock is the move. The company value is near zero, so the tax hit is minimal. Just make sure they file the 83B election within 30 days or they'll lose that advantage. Then, once you start bringing on full-time US employees, ISOs are usually your best bet. The tax advantages go to the employee, which makes it a strong recruiting tool. You'll typically set up your equity plan once institutional investors start coming in, and that's when you'll be set up to issue ISOs. For advisors, contractors, and international teammates, NSOs are your only real option. ISOs can't be issued to those people, so don't even try to make ISOs work here. It's NSOs or nothing. And when you hit later stages, RSUs start to make more sense. Employees don't have to worry about strike prices or exercise decisions. It's a cleaner experience for them, which is why you see RSUs more commonly at Series B and beyond. Now, if you're in the process of setting up equity for your company, here's what I'd recommend. You can absolutely try to do this yourself. Download the templates, file the paperwork, figure out the 83B elections. But equity is one of those things where if you get it wrong, you usually don't find out until it's too late. So here's what I offer. We do a free consultation where I look at your specific situation, who you're bringing on, what stage you're at, and what your plans are for equity. And I'll tell you exactly what structure makes sense and what documents you need. I've helped dozens of founders through this exact process, and I'd love to assist you as well. So click the first link in the description to book that free consultation. And if you want to see the most common legal mistakes founders are making with their startups, then watch this video next.